The market is waiting for the Fed to make its latest decision on policy, and heading in, the broad consensus calls for another 25 basis point rate cut, though at this time, the broad consensus has become a little less broad in the lead up. If we look at some of the key themes the Fed has been citing as the drivers of its decision making, it could be easily argued that these themes have moved in the direction that would be less supportive of a downward adjustment on rates. Uncertainty associated with the global trade war has calmed, risk associated with Brexit has been reduced, and inflation metrics, while still subdued, are showing signs of turning back up. And so we see the balance of risk leaning towards a mid-cycle adjustment, hawkish cut decision, which could very well prove to be a letdown to global investors. This would be more supportive of the US dollar on the yield differential and bearish equities, at least on the surface. But as much as it looks like the Fed could lean that way, we also wouldn't be surprised to see the central bank finding a way to deliver a decision that ends up satisfying investors and leaning more to the dovish side. A lot of this has to do with recent headlines, geopolitical risk in the Middle East, and the latest liquidity injection from the New York Fed to stabilize the money markets are the types of things that the Fed could use to justify leaning to the more dovish side of expectation. If this happens, look for the US dollar to come under pressure and the stock market to try and find its way to fresh record highs. That's all for now.